ESG investing has gone from a niche pastime of wealthy philanthropists and Nordic foundations to mainstream in just a few years, driven by climate and more recently the COVID crises. In fact, in the first quarter of 2021, European sustainable funds attracted inflows of 120 billion euro, representing more than half of overall European fund flows. But what difference does this actually make to our society and our environment? Is the financial services industry perhaps too focused on regulatory compliance rather than real impact? And what is the difference between impact investing and other ESG investment strategies?
Well, Andrew, let me give you a straightforward definition. So I would say impact investments are investments made with the intention to generate positive, measurable, social and environmental impact alongside a financial return. And I distinguish between investor impact and enterprise impact.
Jamie, is there a difference between what's understood in finance as the alignment approach and the impact approach? In other words, is there a difference between an ESG strategy based on a classification system and a taxonomy, or one that's actually based on changing the way the enterprise actually functions?
Yes, and I would say that alignment versus impact, that actually reflects the distinction between investor impact and enterprise impact. So to give you an example, a solar energy installer has an impact on carbon emissions, but the investor's capital doesn't necessarily have that same impact.
It certainly reminds me of the concept of the European Investment Bank and indeed other multilateral banks of additionality. That we obviously finance projects that have an impact, but we also have to show we have an impact on the project itself. That the multilateral actually has to accelerate, improve, strengthen the project itself. And I think there's probably a similar concept at work here in impact investing. Julie, if I could turn to you, the Luxembourg Stock Exchange has long obviously been a pioneer in green finance, and particularly under your leadership, obviously we expect that to continue. You've recently launched an initiative called the Climate Bonds LGX Climate Aligned Issuers Initiative, which goes beyond the traditional green labeled bonds approach to open up climate investing to a new universe of issuers and perhaps investors. Can you explain a little bit more about this initiative, what the philosophy is behind it and how it's going so far?
Well, indeed, the climate aligned issuer section on LGX has been launched in partnership with CBI, the Climate Bonds Initiative, in February this year. It's a new issuer section to complement the existing product section, which covers green, social, sustainability, and sustainability-linked bonds. The objective is to highlight private and public companies that derive at least 75% or 95% of their revenues from low carbon activities. So all their bonds, whether labeled or not, can be considered as sustainable investment opportunities. And the philosophy behind is really to highlight untapped opportunities in the broader sustainable investment universe beyond labeled bonds. So far, we display 23 climate-aligned issuers on the platform. Issuers come from 16 different countries. And so we are in a position now to display 160 non-labeled debt securities listed on our green exchange.
Is this an attempt to open this up to other issuers who perhaps were too constrained or curtailed by that approach?
So that was clearly the objective, because investors care about the impact of the investment and they want to support companies that operate in an environmentally friendly sector. While companies with diverse business activities, automotive, for instance, bank or oil company, they can issue green bonds because they will finance very specific green projects. But the climate-aligned issuers are often pure players, which focus on one business activity only, such as low-carbon transport, which is, for instance, the case for railway companies. So by buying debt from these companies, investors support the low-carbon economy because they help finance not only a green side project, but companies that are active in sustainable sectors, even if these bonds are not labeled as green, social, or sustainable.
You mentioned sustainability-linked bonds, Julie. You probably, I'm sure, saw the transaction quite recently by actually a former client of mine at EIB, PPC. It's the Greek national power utility that issued a sustainability-linked bond that included this step up in interest payments if it didn't cut its carbon footprint by closing down some of its dirty power generation within a certain time frame. Is this the type of instrument that's been issued through the exchange?
When issuing a sustainability-linked bond, the issuer commits to future improvements in sustainability outcomes by a set date. So SLBs represent a source of financing for issuers in all industries that disclose their sustainability strategy and commit to set clear, measurable, ambitious and science-based targets to become more sustainable. So those are new instruments, but also relatively straightforward and providing measurable impact. So receiving extremely positive investor feedback. It's growing very fast and with a huge potential because it can be applicable across multiple sector and issue types, including transition industry, including emerging market issues, for which the lack of bankable green projects might be an obstacle for classic green bond format. And I think approximately today we have around 80 sustainability-linked bonds in the market. So the market is really growing faster than the green bonds at their debut. And most of them use CO2 reduction indicators. And at the end, investors might even prefer this type of tangible targets than the traceability of use of proceeds. It's really important because SLBs can help high polluting industries to get access to capital to finance a transition pathway. And we want to encourage all type of issues to onboard on the pathway to carbon neutrality.
What do you think about the relationship between an investor who gets more money if the issuer actually doesn't perform well in terms of their ESG performance?
This might not be indeed the right incentive, and there's a lot of debate around it in the market, especially for impact-conscious investors. A coupon step-up might not be the right motivation to invest in SLBs. Indeed, if the companies fail to reach their sustainability goals, how will investors consider or measure the impact of the investment at the end? So some alternatives are discussed in the market, and one alternative could be, for instance, that companies donate the extra interest investment instead of giving it back to the investor, but to charity, or could even agree to set even higher sustainability objectives with a different time frame.
Jamie, I'd love to get your thoughts on this particular issue, but also one other issue, just in relation to sustainability-linked bonds, because Julie has just said, in fact, in some ways, it can be a more powerful instrument than traditional use of proceeds or label bonds in some industries and transition industries in particular. And yet it's hard to stick sustainability-linked bonds into the taxonomy because they're not aligned. There is no use of proceeds. And so investors that want a high alignment with the EU sustainable finance taxonomy may look at sustainability-linked bonds and go, actually, that's not the right investment for me. Does that mean the taxonomy is a little bit narrow, Jamie, in terms of limiting the options available for impact-oriented investors who want some type of external accreditation for what they're doing?
Well, first of all, Andrew, let me just add to my enthusiasm for the sustainability-linked bonds to Julie's, because I think it's a really important development, and I want to make sure that people don't think of it as making it easier for people. I think it expands the application of the concepts of sustainability to a broader set of circumstances. It is not easier. It's not like the labeled bonds. Green bonds are the really tough stuff, and this is the easy stuff. On the contrary, and I think that goes to the heart of what we're trying to do, which is to create sustainable companies and not just sustainable projects, which is really what a use of proceeds bond ends up being. So it goes to the heart of who is a company, how do they behave throughout their organization in all of their activities. I think it's a great way to capture that. To your point, Andrew, on the green taxonomy, I think the green taxonomy was a tremendous overture, a great beginning, but it's a partial solution. What we're talking about here is a complement to the green taxonomy. And so in many ways, it goes beyond the green taxonomy. That would be my view. It goes beyond the green taxonomy. It's not in contradiction, but it enables a whole discussion with a whole set of companies that we didn't have before, just based on the taxonomy.
We have to pay attention that for SLBs and the EU taxonomy, it's not the same level of application. So for sustainability-linked bonds, the level of assessment is at the level of the company, while in the EU taxonomy, it's all about the activity. So you can increase or adapt activities to the taxonomy technical screening criteria, and that could permit the company to reach sustainability-linked bonds targets. And on the other way around, SLB targets could also be based on the taxonomy. So for me, there's no contradiction.
That is a good point, Julie. And in fact, I suppose if you take the example of Jamie's service-oriented companies that don't have a lot of CapEx, if they're making ambitious commitments on sustainability as part of a sustainability-linked bond, inevitably they're going to have more, at least OpEx and revenue that's taxonomy aligned. So indeed, there may well be a crossover between the taxonomy and the commitments companies are making.
Every enterprise will be expected to build a path to net zero in their operations. And so you really do need something that helps every enterprise and not just a specific subset of enterprises get there. So to the extent that net zero becomes an important trend, which I think is quite a powerful trend, I think that these structures, the sustainability-linked bond issuance, is a tremendous way to start to build the net zero momentum.
Also in the different projects of the EU high-level expert group or technical expert group, I worked particularly on the EU GBS, the Green Bond Standard. And interestingly, the Green Bond Framework has now been expanded in the EU GBS, so as a new standard of green bond in Europe, to the sustainability strategy of the issuer. So even if this framework and this standard should only apply to issuers that are in a position to finance a specific green project, they have now to define and demonstrate the sustainability strategy in the green bond framework.
So a company that's massively expanding its investments in coal can't just issue a green bond for a small renewables investment.
Nobody is asking to be brown to green from one day to another. Transition, by the way, is included in the taxonomy, but you need to show commitment, engagement, and efforts to reach the net zero.
When it comes to putting pressure on investees and corporates at the enterprise level to adopt more ambitious ESG strategies, in some respects, some people argue the credit markets, in fact, are more powerful than the equity markets in this regard. Julie, what do you think? And obviously, you have a particular perspective on this, through the Luxembourg Stock Exchange.
Yeah, indeed, I'm a bit biased, but so in capital markets, I think everything started with the fixed income markets rather than the equity markets, and simply because it's much more easier to, as we just explained, to assess a specific predefined project and the instrument which is used to finance this specific project. How do you define green equity? It's much more complicated because it's not linked to one project only, but to all sources of revenues. You need also to look at the supply chain, the providers. Everything should be taken into consideration. So what I believe is that we are currently in this transition decade where we observe this very important shift from the project level assessment to an assessment at the level of the company. Because for most investors now, financing a green side project is not enough, and they want to understand the overall impact of their investment beyond a single project. So, and I'm convinced as well that in the future for debt issuers, they will need to have a credible and complete ESG profile as a precondition to access capital markets. There's clearly no other choice. That's extremely important. It's a huge shift. So companies that fail to embrace sustainability will not be able in the future to raise capital, or the cost of capital will increase a lot.
I've never quite understood why people associated sustainable investing with equity exclusively. I've never quite understood that. I've always thought that debt has a role to play. And as Julie says, that they're complementary. Equity exercises discipline through proxy voting and shareholder resolutions, through the ongoing conversations you have with management. And debt can exercise a discipline on a company by creating preconditions for debt issuance. The one thing I would say is that most listed companies issue debt more often than they issue equity. And so I think the bond issuance is an opportunity to have a conversation with a company. And also to the previous observation that you made, Andrew, about additionality. Debt capital tends to be new capital. Debt capital tends to be additional capital, whereas equity capital is existing capital. So from an additionality standpoint, when I, as a sustainable investor, buy and sell equity shares, I'm not contributing capital or taking away capital from a company. Their capital position doesn't change if I trade shares. But when a company issues debt, they're raising new capital and they become accountable, potentially become accountable to the buyers of that debt through the covenants and the principles that they issue under. So I think that equity and debt have two different opportunities to create influence on companies. But I do think that we've understated the importance of debt for companies exercising projects. The way you exercise pressure on an oil and gas company, I think, is through the debt that they raise to go and do additional oil and gas exploration. And banks have exactly the same role. Banks can exercise their influence when they're providing loans, which is another form of debt provision. So I do think that there's a tremendous opportunity in debt to influence the way additional capital goes into a company and how it's deployed.
You mentioned, Jamie, the issue, the thorny issue of financing oil and gas, and whether it's through equity or debt. It raises this debate, obviously, within the sustainable finance community and the impact finance community about whether engagement is the better strategy or divestment. Whether an investor's strike by denying companies access to either equity or debt is more effective at changing their behavior than engagement, in terms of setting the conditions for the provision of new capital for these companies.
I'm not a big fan of divestment. I don't think that divesting from a company deprives it of capital. I don't think it changes the cost of capital. I think that there is very little research evidence to say that the divestment ends up having much of an impact on companies at all. There may be some extreme cases. Coal may be one of them, but in general, divesting from companies does not deprive them of capital and doesn't even move the cost of equity capital that much. I think engagement, that conversation with companies that you have when you're an owner, is a much more effective approach to take. And I think we have plenty of examples of shareholder engagement and shareholder asset owner strategies to pressure companies to do the kinds of things that they should be doing, whether it's in the case of banks lending to oil and gas, moving more of their lending into renewables, whether it's the pressure recently exerted on a UK a grocery company to increase the amount of healthy food that it stocks. These engagement campaigns do move the needle. They do change, they do put pressure on companies. They do get companies to change the way they operate their business. I think it's a much more effective way to engage. That's on the equity side. On the debt side, as described earlier, I think you can have a lot of influence through the kind of labeled and sustainability linked bonds that Julie was describing. I think you can have an enormous influence through debt, but it's a different kind of influence. So between divestment and engagement, I would always vote for engaging with the companies, pressuring them to change their business models.
Unfortunately, we do not always have the majority of votes to support the suggestions of such kind of shareholders and investors who would like to use their power in one way or another, really to push for this transition. And the pressure on shareholders to drive change is high, but not all asset managers are putting actions behind their words. And it's easy to only talk, but harder to walk the talk. And so those who opt for engaging for change should really take concrete steps to engage with these companies, whether through their vote or through dialogue, or demanding more information, asking difficult questions, really raising awareness about what's happening and the importance of sustainability. it's extremely important to push for change and to encourage, to really make sure that things are understood. The shift is so important to be understood, and education is also key at the level of the board. And so I'm also like Jamie, much more in favor of engagement. But of course, there are different views on this important question in the market, and you know it well, Andrew, that some major investors have opted for divestment from fossil fuel like EIB, but like some also sovereign wealth fund, some universities, and so at least they are acting for change, which is the most important.
I still have the scars on my back from the debate at the EIB on pulling out of the oil and gas industry. Although interestingly, it was a little bit more nuanced than perhaps it was made out to be in the press, because we did commit to stop financing oil and gas projects, but a little bit like you both suggested, we are still willing to finance oil and gas companies, but only on two conditions. One, that there was a use of proceeds approach, so that it was for renewable energy, and also that they would commit to wider sustainability objectives consistent with the overall EU energy and climate targets. So yes, I mean, I think even EIB, which is probably a pioneer in this particular area, did take a pragmatic and nuanced approach to engagement rather than pure divestment.
And Andrew, I think the one thing I would observe is that most people who are really activist about their engagement would also say that at some point, when the company doesn't respond, then you divest. And so in a sense, the divestment is the end stage of an active engagement. So in that sense, you sort of come full circle between engagement and divestment. But they would say you really put your effort into the engagement. And if it's only if it doesn't work that you then say you give up on the company and divest.
I just want to get your views on what's next, do you think, particularly around the taxonomy. Obviously, we now have a partially agreed taxonomy for climate mitigation and adaptation. The intention is now to move into the other environmental goals of the European Union, and then eventually into social objectives, and having a taxonomy around social objectives. I just want to get your views on how realistic is this? I mean, it was difficult enough to get an agreement around climate when everybody agrees net zero is the end destination and science-based targets. I mean, is it realistic to say we're going to have an agreed taxonomy between 27 European countries on our social objectives?
I think it's going to be difficult. I mean, I think that you're exactly right, and Julie knows better than I do. It was a lot of work to get to the green taxonomy. And I think when you open up to the 16 other SDGs, you're going to find that there is such a multiplicity of issues to be addressed. I think you'll find the complexity of a social taxonomy is really quite daunting. That said, I think it needs to happen. And I think it will happen. It may happen a little bit slower, but all social areas can articulate how they create social value. It is possible. It'll take a long time, but it will happen and needs to happen. But the other observation I would make is that I think we're increasingly understanding that there are no environmental measures, there are no net zero measures that we could possibly take that don't already have social implications.
Julie, any views on this?
Yeah, I cannot agree more on what Jamie just mentioned between the interlink between environmental issues and social impact, or all the way around. And it's extremely important for all to have this global overview, the holistic approach towards impact. But I think that the taxonomy is a step-by-step approach. It's an in-progress process. It's extremely complex to put in place. And the idea behind is really to try to strike a workable balance between promoting investment in sustainable activities while including also transitional activities. So the market needs time, needs really time to digest all of this and implement concretely what has been recently adopted. But the important is to act, and to act quickly in the right direction. Nobody can ignore the S of ESG now. The social really came to the fore. We had a 1,000% increase in terms of social issuances in 2020 compared to 2019. Can you imagine? It's just huge. And I think that the interlink between the social aspects and an environmental measure are really now very, very present in the minds of investors, of most of investors. And they are really asking themselves some questions about the social impact of what they're doing. And we see also in France the yellow gilet crisis, because from an environmental measure to protect the environment by raising taxes really trigger a social issues, which is extremely important that politicians have to take into consideration and to have this holistic approach.
I think this concept of the just transition is obviously at the heart of a lot of this, at the intersection between environment and society. And I think it's a concept that's only going to grow in the political agenda over the coming months. Clearly, we could talk about these issues for hours, I think, although there's far too much agreement between Jamie and Julie on most of the issues. But let me ask one final question and see if there's any divergences here. Name one thing you'd like to see this year in terms of a new development, new initiative, whether at the international level or perhaps at the Luxembourg level.
I don't know whether you want something that's new, Andrew, or you want the core issue, because to me, the core issue is net zero. It's the topic that everyone understands. Everybody sees the logic of it. Everybody sees the priority of it. And it has enormous momentum. I was looking at some numbers recently. There's about $120 trillion worth of managed assets out there. When you add up the Net Zero Asset Owner Alliance, which is $6 trillion, and the Net Zero Asset Managers Initiative, which is $37 trillion. And it's $37 trillion. This is the Net Zero Asset Managers Initiative was launched in December, so 6 months ago. They're now at $37 trillion. So we have a third of the assets in the world already declaring themselves for net zero. I think Luxembourg needs to take the lead on the thinking and execution on net zero. It needs to lead on what is the right combination of divestment, engagement, looking for solutions, using carbon offsets. What is the right way to get to net zero? And I think that is the issue for the world and certainly for Europe. And Luxembourg has a real shot at defining what does it really mean to take portfolios to net zero at a time when it has more momentum than almost anything I can think of.
Nice way to finish, Jamie. Thank you. Julie?
Well, I think, let's be positive, some initiative exists yet, like Lux Flags, the labeling agencies, the Green Exchange. But I think indeed the fund industry could do more to fully embrace sustainable finance and set an example for the rest of Europe. As Jamie was just mentioning, we need to be ambitious and to anticipate, so not wait until regulation forces us to act, but really proactively be agent of change. And I think that's a mindset we were able to have in the past. So we should build on this position, on this agility, which is well known in Luxembourg, to continue in that direction. And for instance, by establishing new incentives to attract and foster impact funds. It's often said that Europe pushed change through regulation, while the US drive change through incentives. But maybe there's a perfect balance between the two to find in Luxembourg. And so I'm confident that we can find ambitious solutions and incentives to lead the way.